As we all know, infrastructures are an essential part of growth and development in emerging countries. The current needs for essential services on energy, on transport, on water and sanitation, on agriculture, on digital are huge. Only 35% of the population in sub-Saharan Africa has currently access to electricity. I won't bother you with too many data, but just to have the big picture, to remember that currently we had last year $62 billion of financing for infrastructures in Africa, which is actually quite a stable number for the last 7 years, even slightly decreasing in 2016, whereas the current needs would probably require twice as much as money as what is currently available. The other thing we need to keep in mind is that the fact that given the current level of local savings in those countries, international investors and international investments are desperately needed. And that's the object of this roundtable today. What role should investor play in that regard? For development banks, there are a few roles that we can play. First of all, direct financing, of course. At Agence Française de Développement, we dedicate about 4 billion euros of investment in developing and emerging markets every year. And we can also try to leverage local investment through helping a direct access to finance for sub-sovereign players like municipalities, or try to leverage private instruments through de-risking guarantees or support green or project bond issues. And last but not least, our role is also to ensure a sustainability of the sectoral governance of these infrastructures in terms of operation and maintenance. So the question today, I would say the provocative question is really the money the topic? And what kind of money is needed, and what kind of money are we talking about? Do we need public money? Do we need private money? For what projects? So I'll start by a question on the specificities of infrastructure financing in emerging countries. And I'll ask Bruno Bensasson, Jean-Patrick Marquet, and Gregory Ness to give their views on this issue. Who wants to start? Bruno, maybe?
I will start. So I am Bruno Bensasson. I am the head of NG for Africa, where we developed a mix of activities, namely power production, services, energy services to industry, corporates, or households, and eventually decentralized solutions for more rural zones. So to answer your question, specificities of infrastructure, first perhaps there are essential needs, not only normal goods, but essential goods and services, so they come first in development. Second point, at least for energy, but I believe it's most of infrastructure, they are long-term, so they are long-term investment. And of course, in an environment which is risky or perceived as risky, the longer it takes for the capital to be reimbursed, the more difficult the financing can be. And last, I would say, a good part of them are, from an economic perspective, public good. which does not prevent to organize private-public partnership, but often they have to be financed by public bodies, which, at least for Africa, have not a lot of money when you consider tax on formal economy. However, if you go for energy, and I wish I will finish like that, a little bit like telecom, energy is an essential good, is an infrastructure, useful for social and economic development, not only useful, necessary, but it can be considered as quite a private good, because people can be invoiced for that, and you see more and more the development of decentralized solutions where people pay the cost of their power. I will finish with that.
Thank you, Jean-Patrick.
So Jean-Patrick Marquet, I'm the Managing Director for Infrastructure at the EBRD. Africa, we have some countries in Africa, but the vast majority of our countries of operations are in Eastern Europe, Central Asia, and right around the Mediterranean. What I found very interesting in the previous panel was the conclusion, which was essentially that the money is not the problem. The problem is that there are not enough projects to invest in and to finance. And effectively, in emerging markets, it's the same issue, just square or cube. You have much bigger needs than in advanced economies. And the ability to put together projects that can be investable is much weaker. And we see two kinds of pitfalls, too slow or too quick. We see many investments where the governments are moving at snail's pace, agonizing over every little decision, to the point that those projects become sometimes irrelevant by the time the decision can be made, or you've had a change of administration, change of majority, change of regime, and of course the first decision of the new guys is to say that what the previous guys were doing made no sense. First pitfall. The second pitfall is too quick, where you have a high-ranking policymaker who wants certain projects to take place, and everyone is rushing to bring them to market or to finance, and you have half-cooked projects which effectively no one wants to invest in, and so you are wasting time rather than be more efficient. So it all boils down to preparing the projects to the right standards within the right time frame. And there is a big bottleneck. The capacity is often not there. You don't have the tools, you don't have the people, you don't have the time to do it. And that's where international institutions like us, or like the G20 or the World Bank can play a very important role. We have put together what we call project preparation facilities, which effectively are technical assistance facilities that provide free services to governments to prepare the projects, whether to be publicly financed or organized through a PPP. At EBRD, our shareholders have taken 40 million out of our profits. We are a profitable institution, so they effectively reserved 40 million euro to put into a dedicated project preparation facility. And with that facility, we offer to our clients to finance the studies, to finance consultants, to finance advisory, to ourselves help the supervision, and therefore make it much easier for those clients to effectively bring projects to a stage where they can be invested in and financed. So I will leave it there. I think it's a very important hurdle that we all face. It's the first and foremost of all the hurdles, Clearly, the main theme that I believe in emerging markets we need to address.
Thanks very much, Gregory. Standard Chartered has a long experience in emerging countries in Africa. So what's your
That's
view on
right. We're in 15 countries, wholesale, and in many cases retail, but we follow clients throughout Africa. So we have a project and export finance business specifically for Africa, and that's sub-Saharan Africa. So we do North Africa, but much less than really the middle band of Africa, if you wish. I think from our point of view, there are many, many risks and perceived risks from externally going into Africa, but I think the local presence is quite important for developers. We've seen a wave of funds or developers backed by funds coming into Africa in the last 2 years, and a lot of them have, learnt somewhat the hard way that you need to have JVs with local partners. You need to be really entrenched locally and understand the political will, the players, the parastatals, how the whole system works effectively. I think the other point is every transaction seems to be, on a project financing side, tends to be, we're developing new documentation, we're developing new regimes for PPP programs, for legislation, concession agreements. A lot of this can be taken away back from the markets of Europe or the Americas or other African countries where there has been many successful projects, but we don't see a lot of replication of those project agreements just as a copy-paste into other markets. There are specificities, obviously, of each market, but there needs to be much more of this, of a replication of the risk allocation. The other thing very important for projects is multilateral support and World Bank support that we see in all these projects, not just for the halo effect that can have in terms of they have cross-default regimes into these governments, and you're assured that they will bind by the law in terms of payment regimes, et cetera, or bind by the concession agreements. But also just in terms of the different guarantees you can get. There's a lot of different products multilaterals have come out with in the last 2 years, the DFIs. The World Bank is working actively on many different products. As we speak last week, they had the World Bank meetings, and there's a lot of talk about how they can mitigate risk, for example, convertibility, a specific product for that, for example. So that's very important, multilateral involvement. And then the last thing I would just say is that, financing historically has happened a lot and still does, not just through projects, but obviously through bonds, where specific amounts of bonds are used for infrastructure projects, like in Zambia, for example, like in Senegal, like in states in Nigeria, for example. But also in terms of corporate funding. So we do a lot more corporate funding as opposed to project financing, just because of the difficulties, obviously, in getting these projects going. Last thing, I'll just add in one last thing. I think there has to be a lot of recognition for the developers and the time they spend developing these projects. They think they're going to spend 1 year, 2 years. They end up spending 5 or 6 or 7. They think they'll spend $2 million, they spend 20. And there's recognition in the financing that you can get development fees, and there's a more of a standard approach now that you get recognized for that, so the returns can be quite sizable for developers, and that's something that's quite important for developers to be always attracted into these markets.
And do you think, maybe Julia or Jean-Jacques or Rami, do you think that the investment needs are well covered currently by investors? And if you could answer by yes or no, and then explain in a couple of words why. Julia.
Yeah, well, I'm not going to say yes, I'm going to answer because you're going to get the wrong impression. I'm going to say that no, I don't believe that all investment needs are covered in terms of the investment requirements for infrastructure in Africa. There are so many figures kicking about, and we've already talked about the need for private investment. The one figure I'll put into the thinking is that BCG reckons there's around 12.5 billion required for private investment on an annual basis in infrastructure in Africa. And I'd like to compare that with the fact that over the last 10 years, only 4.5 billion has been raised for equity, 24 equity funds in Africa. So if you look at it from the private sector equity side of things, there is a clear gap in need. And we've talked a little bit as well about how that gap has been created, that it's not just a financial gap, it's a gap to do with capacity building, it's a gap to do with transactions that are actually being delivered and executed. And again, linking that as to the type of equity and the type of people that are putting or fulfilling the identified investment needs. In order to get a project, finance a project across the line, you not only need money, but you also need a very strong sense of how that project is going to be molded, supported through its journey from the development to the investment to the operation maintenance period. And I think certainly as a fund, Meridiam is particularly focused on that journey through investment, and really feels that more holistic approach fulfills the investment needs, not only through just the governance side of things, but also the key environmental and social aspects that go into fulfilling investment needs in Africa. And so the answer to the question is no. The answer to the question is changes are being made, partial fulfillment and consideration of investment needs. But it would be good to get a similar approach being taken across the board by investors going forwards. If I could add another way, perhaps, in which investment needs are being taken into account, we haven't actually used the blended finance words yet, because I think this is a change not only in investment approach, but also in linking together sources of public and private money going forwards. We've seen blended finance already with our friends in the EBRD in Turkey being successfully achieved, but we're also seeing blended finance through the MCPP facility that the IFC has promoted together with Allianz, who have also been a trailblazer in taking that blended finance approach. So no, things are getting better, ideas are getting better, and hopefully more funding is coming in as well.
Thank you. Jacques?
Yeah, no, thank you very much. I think I agree with a lot of what has been said, and my direct answer, are the investors' need covered at the moment? My answer would be no. And at the same time, my answer to your initial question, is the money there? My answer would be yes. So definitely there is a mismatch to be addressed. So maybe trying to give you, I would say, a global asset management manager perspective. At Amundi, we manage a little more than $1.5 trillion US. And 80% of that is for institutional investors. So we roughly have, I would say, a global view of what are the institutional investors' needs and demands. We serve a little more than 2,000 worldwide. And I think there is something to be said. If we look at what is the total amount of AUM owned by these long-term institutional investors worldwide, we're talking about something which is like 100 trillion. So that gives you the order of magnitude of the potential flows that can be generated. But at the same time, it is quite clear for me that out of this 100 trillion, it's a minority part of it that will go directly to project financing. So the question that we have as Amundi is that as we are mostly, I would say, a public market investor, despite the fact that we have developed our infrastructure franchise also, is, for me, the true question is how do you create the proper asset classes that can help institutional investors to invest maybe the traditional way they do to channel money into infrastructure projects. And for me, that's really the key challenge, because I don't think it's true to say that we're going to see huge increase in trillions in direct project financing. I think what we need to create are really the channels that may make possible for these investors to finance or refinance infrastructure projects in emerging countries in particular. And at least that's one of the challenges I see and one of the bottlenecks we have in front of us at the moment.
Thank you, Jacques. Amit, maybe you want to add something?
Yeah, Amit Tofiki, CEO, CDG Capital. CDG Capital, in fact, is the investment banking and investment management arm of Caisse de dépôt de gestion in Morocco. So I want just to bring something from a view, local view from investor, in fact, and how the institutional investor are trying, in fact, to invest in this asset class. So the answer to the question is no, but I'm optimistic that it will be developed very quickly. Why? So we said before what are the main specificity of emerging markets or in Africa. I think I would highlight one point which is important, which is the case for other emerging markets, is that the omnipresence of MDBs and regional development bank, which is, I think, very important, and which something which is, I think, has to evolve according to the development of each countries. And in order to be able, for example, to succeed in blending, in fact, finance, we have to have kind of catalytic approach of the development bank, and to be able to bring in local investor, local commercial bank to come into the project. I give you just an idea about, for example, in Morocco. We are managing the biggest pension fund, in fact, in Morocco. For the time being, everything is almost invested 80%, in fact, in local treasury bonds, and a portion of it, 15-17%, in fact, in the equity market. But we are now discussing with the regulator and with the Ministry of Finance in order to enable, in fact, local pension fund to have the possibility to invest, in fact, in infrastructure. We set up 6 years ago a fund dedicated to infrastructure, whereby you can invest, in fact, in equity. And I agree that as it is something new, it took time to close deals. But I think we learn from this experience, and also the people involved, that we have, in fact, to adapt a skill and also the governance in order to be able to respond to the need of private investor. But I think what is important going forward is really, and this is one of our objectives locally as an investment bank, working closely, in fact, we are also considered as a national development bank, and I think this is something where National Development Bank can play the role of structuring deal together, maybe with some regional banks, in order to enable to attract pension fund money, insurance fund money locally. And I think when we succeed by doing this, it will be much easier, in fact, to attract foreign investors. Another point regarding the specificity of the African market, which is linked to what I've said before, which is the importance of MDB financing and regional development bank financing, is that a lot of infrastructure are financed in hard currency. And this is something which is important to have in mind, is we have a risk which is now increasing a lot, and we have to think on how we can, there is no way to manage this type of risk as of today with the instrument we have, but it will be, I think, important for regional development bank or MDB to help some of the country, in fact, to develop their local capital markets, because to be able to have a sustainable infrastructure financing in Africa or in some country in Africa, it has to be rooted in the local capital market.
Thank you, Bruno.
To add on your question, are needs covered? Obviously, no. I must remind that Africa has the same power capacity as Germany, 190 gigawatts, 2/3 of the consumption being in the Republic of South Africa and the region of Northern Africa, which leaves the consumption of the other 800 million people at the level of Poland. So no, the needs are not covered. And I would add that only 30% of sub-Saharan Africa has power, so 600 million people without power. And if we don't change the situation, there will be 1.5 billion by 2050. Nevertheless, I would say that there are some reason to hope. One being the example and catalyst of the telecom sector. When you bring some good technological solutions to people, they adopt them and sometimes quickly. The second, I would say, good news is that the cost of energy, and especially of decentralized energy solution, is getting lower, sometimes drastically, if you take solar. And of course, in some African geographies, because they are very diverse, when the density is low, to have low-cost decentralized solutions is good and even necessary. And the last point is that there are, on the continent, excellent regulations. If you take Morocco, to a certain extent, South Africa, if you look at how Kenya deals with foreign exchange risk, they are a very good example. You don't need to go across the world to find good regulation. And when you find good regulation, especially cost-effective tariffs, then you find good projects and good people to finance them. Unfortunately, those good regulations, they don't spread as quickly as African countries would need. But certainly for centralized and decentralized solutions, if you look carefully, you will find good regulations. I hope that with their spreading, we'll be able to profitably electrify the full continent far before 2040.
If I can just add to that in relation to investment needs, I think one of the things that hadn't been mentioned was in relation to the procurement processes. And I think that that's one of the bugbears in terms of fulfilling those needs. And it seems to me that one of the best examples of those is actually what was seen in South Africa with the REI PPP solar project, which attracted nearly 6 gigawatts of new solar, of around 14 billion of investment, over half of which was actually FDI investment. And there are certain aspects of that that can be rolled out into other markets in terms of replicability, similar documentation, similar evaluation processes. And it seems to me that as well as getting money, providing energy, we also need to make sure that procurement processes are such that people can, with of course their own national concerns being factored in that, but they can actually give a good, solid pipeline of projects that investment can be made in.
Yeah.
If I may get back to the question of whether investment needs are met, I would say effectively today those needs are met because there are not so many projects to finance. So the few projects that are investable, they find finance. They find a few adventurous investors. You always have the multilaterals, you have some export credit agencies, and a few international banks that are ready to finance. The problem will be once those countries get their act together and bring many more projects to the market, that's where the issue will be. And those existing players will not have the capacity to step up as needed. And it's not with the new US administration that the World Bank will get a massive capital increase to expand its lending. So we have a real issue there. And Julia, hinted at the fact that we need to do much more blending, and that's clearly the way to go in the medium term. And an example that we have together with Meridiam is the case of a hospital PPP in Turkey, where we have managed together to attract bond investors into a greenfield project finance type structure in an emerging market, where effectively EBRD provided some liquidity facilities to credit enhance the bond, and MIGA signed a political risk insurance to also make it investable for investors. So it's this kind of scheme where you can effectively mobilize investors, that would probably not look at this market, this type of project, this type of maturity without the added benefit of a risk mitigation scheme. So medium term, that's probably the way to go.
But can I just take issue with the yes, there is money available for the projects that are out there. And I'm quoting from a survey that was done by DBSA, Development Bank of Southern Africa, as part of their overview of what the real issues were in the African market, which was done, and I apologize, I'm not giving you the acronym, so it takes slightly longer, the Sustainable Development Investment Programme, which is supported by the OECD and WEF and many others. Now, they, in their survey, which they looked across a whole series of different projects across Southern and Eastern Africa, again, it came up and up. The issue was the availability of capital, exchange rate risk, cost of capital, and counterparty credit risk in that order. So whilst, yes, if a project comes along, it's high profile enough and something gets cobbled together, then possibly projects will get done. But certainly, projects that are underway and in development in the marketplace are still citing the availability of capital as being their main challenge. And I think that that's something that by using blended processes, by using methods to actually assist project and project sponsors to get across the line is still the key criteria going forwards.
So we've been talking about preparing projects, the gap in equity, the need for diversification of sources, the need to mobilize local finance. Maybe a last question for you all. What initiatives do you think will definitely be needed in your dreams? What would be the thing you would like to see that will be a real catalyst for financing infrastructures in developing markets? Jean-Jacques, you want to start?
Yeah, I don't know if it's a dream, but at least I can echo one example. I think I fully share the view that basically the development of blended finance is a promising avenue. And so in that respect, there is an initiative we've been part of with the IFC, so the subsidy of the World Bank. And the idea was quite simple. The idea was to say, after emerging countries took strong commitments at COP21, there will be massive needs of financing green transition of emerging economies. To channel the institutional investors' money there is an asset class that should be kicked off, let's say. It's the green bond market in emerging countries, which is a market that doesn't really exist anymore. At the moment, it doesn't exist for real. You've got 168 billion green bonds in the world, and 90% of them are located in developed countries. So developing that asset class is a way to channel institutional investors' money in financing or refinancing projects that could be infrastructure, for instance, in emerging countries. And to do that, to meet the challenge, what the IFC has decided to do was to address both the supply and demand question by setting up a fund that we're part of, where basically the IFC plays the role of the first loss taker. So basically what they do, they are the single investor in the junior tranche. And afterwards, it's our job to find institutional investors to meet a 2 billion target fund that will invest into green bond issued in emerging countries. That will directly or indirectly finance or refinance projects in emerging countries. This is only an example, but it's an example of development of an asset class where institutional investors can easily get in. So I think this type of approach, apart from all the programs that are run by the MDBs on project financing, is a very promising avenue. And I think this probably could be duplicated in the future in the field of we're talking about.
Thank you and good luck. And as we will take part of the mezzanine, I really hope that you'll manage to get a real success in your fund. Julia.
Well, I'm delighted to say that it's always, in fact, the bond that we were just talking about in Turkey was a green bond, and it's always our intention to, as far as, which is one of your 10%, I think, in the emerging markets, and it's always our intention to structure bonds that have that or structured financings that have that very much green and very strong ESG elements to them. What would I really want to see and support? That is that a fund and institutional support to assist in capacity building in a number of the emerging markets, to make sure that information is readily available, that support is given in terms of structuring projects to get them to financial close. And I think that's going to be a really, and also beyond, I think, to assist in both the construction and operation maintenance periods going forward. I think that's a really critical part of ensuring that more infrastructure, and particularly greenfield infrastructure where the need is greatest, is developed in the emerging markets. Lots of blended finance as well, but that would be my first wish.
Thank you.
I mean, for me, the big focus is always at project preparation and financial close. But fundamentally, the long-term challenge is how those projects will be monitored, the contracts will be implemented, and effectively investors will get their return and the banks their money back over the 20 years that follow all of that. And that's clearly where we will be able to say whether things have matured or have not. And it still remains to be seen in many emerging countries whether those projects will be managed by the public side in a reasonable and constructive way in accordance with the contract and the rule of law, or whether there will be political turbulences that will make projects effectively extremely difficult post-completion. So my wish is that we see emerging that capacity within governments to effectively properly monitor and support those projects as they operate.
Thank you, Bruno.
I think we face a misunderstanding in a certain way in certain countries between the public accounting and private accounting. From a public perspective, the question is, do I have the money before the project to finance it, to pay for the equipment? From a private perspective, the thing is very different. Shall I get my cash flow back on 10, 20, 30 years to get the decent profitability or the decent likelihood of a decent profitability? So my first wish is that those two worlds, public and private, African and European, talk more to understand each other better. Based on that, the second wish is that good regulation spread, and especially cost-reflective tariff spread for the benefit not on investor but of African economies and African people. Because as long as I tell you that my price do not cover my cost, you won't invest in my project, you can blend it as you want, there will be always a missing money and a lack of investment. So I would say that the first thing is to set up this thing that does not prevent countries to do some clever social policy between richer and poorer households, between industry and households. All that is possible, but if you don't admit that a good has to get a price close to its cost or at the level of the cost, no one will produce the good, and there will be a lack. Once that is done, and I think that comes first, then you can imagine blended assets. You can also imagine guarantees. But guarantees, if you have not prevent this moral hazard, they will be too expensive, they will be subsidies and not guarantees. So I welcome guarantees, but they'd have to be, I would say, political give and take, where you give the guarantee, but on one side you reduce the moral hazard on the other side. And the last wish, if you allow me, is that those structured class of asset concern not only large infrastructure, but also bundles of small or very small infrastructures such as microgrids and solar home systems, because the technology is such that in the past we were doing some big plans for 1,000 megawatts or 10 megawatts. Now the microgrids are 1,000 times lower kilowatts, and the solar home systems are again 1,000 times lower watts or tens of watts. So we will bundle them, but thank you, investors, to also accept a kind of new assets with a kind of B2C consumption credit risk. I don't think it will be bigger risk than the traditional regulatory risk, but it will be a sum of very small stuff that you will have to look at, please, too.
Thank you, Gregory.
So from a lender perspective, I think I and many of my colleagues would have three wishes. One is, there was a discussion on the previous panel about all the regulations coming for bank balance sheets in terms of Basel, IFRS 9, things like that, which there's a lot of debate amongst commercial banks or within commercial banks about the treatment for these, which is a bit more detrimental than positive, to be honest, at the moment. So if that regulation could move positively in the right direction, I know that's a very much a wish list from our senior management in the bank. The second point is, and also it involves other products as well. For example, MIGA that we mentioned, banks don't get risk transfer for MIGA. So for us, we have the same pricing if it's MIGA or no MIGA, even though that is a substantial risk that's being covered with MIGA, for example. And most banks are like that. So there has to be a treatment of these products in a positive manner. The second bit is local financing. We talked about, there was mention about that. That's a very important point, not to use hard currency for every deal. There are now solutions for 20 years plus local financing, which have been banked now with the help of the World Bank. So there are solutions which include refinancings in base cases, but there needs a bit of political will as well from the governments to support that. And the last bit of my wish list would be just amongst the DFI community, where that's the first lender of resort for many of these projects. We need a better syndicated model with DFIs, as in if you appoint one or two MLAs, lead arrangers, we need to have it so that we're not discussing a term sheet for 2 years with 5 people from each institution times 15. It just takes forever basically. So you extend the timeline of discussion by at least a year on a term sheet, just because we don't have a better syndicated model, not just within DFIs, but also with the banks. It's a club basis. We know these are very difficult deals, but there needs to be a bit more of leadership with lead arrangers.
Thank you, and point taken. Hamid?
I was thinking, in fact, of what happened, I think, since last year. You have to aim for the impossible to make it happen. So I will try to make a wish. Is the following, in fact, is seeing the mutation or transmutation of MDBs and National Development Bank into MDIB or NDIB, i.e. Multilateral Development Investment Bank, acting, in fact, not only through the balance sheet and taking the size of the balance sheet as a measure of the impact they have on the country. I think this will make a change, and we'll have this initiative that were discussed here and there being a second nature of the way National Bank act, and I think it will be an accelerator in order to make this blending, this wedding of odd couple between the public money and private money, something which is natural.
Thanks a lot. So, to end up on a positive note, I see that you have dreams, but also solutions, and that at the end of the day, things are moving in terms of innovation, in terms of reducing moral hazard, in terms of mobilizing local financing, improving capacity building, and maybe simplification of the work of the financial institutions. So that's all positive, and hope that effectively, accompanied by a good regulatory movement, we could improve the situation for the financing of infrastructures in emerging markets. Maybe there's time for a couple of questions in the room. Does anyone want to add something? Yes?
Good afternoon. I am Stéphanie Capdeville from the Green Climate Fund. As several institutions here are accredited to the Green Climate Fund, so I would like them to express their wishes as well, or their experience, especially as we are just at the edge of the COP23.
So does anyone want to develop on their experience with the GCF, or everything's fine?
Well, it's effectively starting, and things still need to get into place. But I think the very positive element is that everyone realizes how critical this is. The COP commitments are now part of the strategies, effectively, of all the institutions. At EBRD, we have decided to increase the share of our investments going to climate topics towards 40%, and we are actually getting pretty close already to the target. The positive things is that the realization is now widespread that this is the top priority. And we will all try to draw on resources like the Green Climate Fund to make it happen.
We just been accredited, in fact, in July. It was a long process, 600 documents in 2 languages. So we started, in fact, working seriously on project and trying to do what I just described, in fact, the blending finance using in GCF, and also the fact that we can have long-dated maturity, and also taking a different risk or accepting the lower IRR, and showing that we can finance a project by having a different type of risk allocated to different type of investor. And I think this will be a very good opportunity, and I hope that we can close a project very soon. Thank you.
Thank you. Last question.
I'll take advantage of that. Jacques Calou from the IMF. So thank you very much. Yeah, there's a lot of capacity building going on upstream on preparing projects. Someone mentioned that there is need to monitor projects and make sure that funding flows back. So whose role is that? Should it be development finance institutions or some other initiative?
Well, I mean, perhaps if I could respond to that. I think that as projects are developed and built and then operated over the long term, they are usually structured on the basis of contracts. And those contracts clearly set out how the relationship should develop. Now, those contracts both have public, usually, and private sector engagement. And they should be the underlying basis on which the relationship works going forwards. And to a very large extent, I think that this has been the practice, and it has been carried out in that way. So that rather having a supranational institution coming and looking down, perhaps it's really up to both public and private parties to carry out their duties in the way that they've agreed to do that.
If I can add on this one, ENGIE, as I would say, a very international company, always partner with local actors. We are both developer, financer, and operator. So contrary to some developers that go and leave and you wonder, is it a good project or not? We partner, but we keep some, I would say, skin in the game. So that should be a good sign that the risk of the project has been considered and that the operation and maintenance will be done. And I would say the financial close is really the moment of truth, where people gather around a project and wonder if on the long term or not, the cash will, I would say, gives a sounded IRR to the project. So I would say that the commitment of the shareholders under the survey of the lenders could be considered as enough, at least in our model where the developer and the financer and the operator is the same, so with no diverging interest. However, on the long term, there will be no sustainable energy development without a good payback, and that means cost-reflective tariff. And for that, it's more, I would say, a public-private dialogue that any survey that will allow for that.
Thank you very much. So let's end here, and I'd like to thank all the panelists for today.